Hey guys, Dave Keller here with Market Misbehavior. Today we're going to talk about the complex head and shoulders pattern. So a very popular pattern is called the head and shoulders pattern. It's talked in a lot about So you're probably familiar with the head and shoulders topping pattern. It's a pretty popular pattern, referred to often in technical analysis. A lot of the foundational books, like the Edwards and McGee book, Technical Analysis of Stock Trends, John Murphy's Technical Analysis of the Futures Market, and others refer to this key pattern because it is an important reversal pattern. It suggests when an uptrend phase is exhausted and there's no longer the upward momentum that can propel the price to making higher highs. We put in a lower high and then we break down. And it really is a way of confirming a rotation from a bullish phase to a bearish phase. Now, a complex head and shoulders is sort of riffing on that pattern a little bit. Has what's called a complex pattern. So instead of one shoulder on each side, it has multiple shoulders. A lot of the analytics and a lot of the techniques are very similar. We're going to look at an example, Las Vegas Sands LVS, which is a gambling name, recently featuring this complex head and shoulders topping pattern. Before we get to the charts, make sure you like this video, subscribe to my channel, won't you? And also let me tell you about one quick offer. Today's video is brought to you by Seeking Alpha. I'm a big fan of places that allow you to better understand the market environment. I think seekingalpha.com is certainly one of those. When you go to the website, I would check out the stock screener, particularly because it allows you to use Seeking Alpha's proprietary quant model. In my experience working with institutional investors, we always had what's called an alpha model, or a quantitative model, which really modeled the characteristics of strong companies, demonstrating strong growth prospects and strong price momentum. Seeking Alpha does a really good job of taking that institutional level quantitative capability and putting it in the hands of individual investors. If you go to marketmisbehavior.com/seeking alpha, or just click on the link in the description below, you can go right to a special offer. If you use the link, you get $50 off your first year and also get a 7-day free trial to check everything out. So go to marketmisbehavior.com/seeking alpha. Now back to the video. All right, so here we're looking at the chart of Las Vegas Sands, ticker LVS. You can see from sort of mid-2022 to mid-2023, we have a fairly consistent uptrend, right, of higher highs and higher lows. And notice the low in March leads to a new high in early May. Then we pull back again and make a series of lower highs. So this is the complex head and shoulders pattern. A head surrounded by multiple left shoulders and multiple right shoulders. Now, what is a traditional head and shoulders pattern like? Well, ignore this one, ignore these ones, and just think about sort of the head, one left shoulder, one right shoulder. That's sort of the classic head and shoulders pattern. The complex head and shoulders just has one clear peak at the top. That's the head. And then what makes it a complex head and shoulders, you have multiple shoulders on the left side and the right side. Now, things to look for. The shoulders ideally have a pretty similar level, and I think that's why Las Vegas Sands is such a great example of this complex head and shoulders pattern. Look at how the left shoulders and the right shoulders all have resistance around the same price point, right around $60 a share. The head is clearly differentiated by the gap higher to make the new high around 65. Then we settle into the multiple right shoulders right around that same level. Another thing that marks this as a pretty classic complex head and shoulders pattern is a very clearly defined neckline. Look at the swing lows, right? The intermediate low point among all these left shoulders is right here. You can see to the right side we have a number of lows kind of around the same point. If you take a trend line from the March low, which is sort of the beginning of the neckline, connected to that first low here in May, you'll see that lines up really well with the low in July. Now, Trendline 101, if you're familiar with trendline analysis, basically says once is chance, twice is coincidence, 3 times is a pattern. What that phrase implies is that every time you test a line, the more and more it validates that as a proper representation, a visual representation of the pace of the trend. And that's all a trend line really is, right? It's visually representing what you're seeing on the chart. And the more that you test that line, that's just the chart telling you more and more, yes, that is an accurate representation of the trend of the stock, and gives further confirmation or further rigor to the idea that when we finally break that trend line, it tells you something's really changing, right? Because the more that we've tested that trend line, the more it confirms that 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 is a correct representation of the trend. We break the trend line that tells you something's different. So in this case, the neckline in March, in May, connects really well with the low in July. And then you can see the break in August, something's different. So anytime you have a pattern, you need to remember that there are 3 steps to every pattern. I'll probably do other videos really highlighting these 3 steps. You have the setup, you have the trigger, and you have the confirmation. Let's go through each of those really quickly with the complex head and shoulders pattern. The setup is basically what happens before you break the neckline, right? So as you sort of have these levels here, and it looks kind of like a double top, and all of a sudden, or maybe a triple top, you make a new high, and then you sort of pull back and make these additional, right shoulders. All of a sudden, it starts to look like a head and shoulders or a complex head and shoulders pattern, but you can't call it a confirmed pattern until you break the neckline. So the setup is sort of this period here where it's starting to look like it, and you get an idea in your head like, okay, this looks like a complex head and shoulders. It looks like a good neckline is breaking, is being set up, which means you're looking for the trigger. And the trigger is that second piece. Until you get that trigger, it is not a valid complex head and shoulders pattern. So the neckline is really important. Having a clearly defined neckline, ideally, which slopes a little bit up in an uptrend and then is broken, is a pretty classic shape to that. Breaking through that neckline is the trigger. The third piece, after the setup, forming the pattern, the trigger, breaking the particular trigger point, then you have the confirmation, that third piece, which means how can you validate that breakdown using something else? So different things you could think about would be, do we break additional days to the downside, right? Once we break that neckline, do we see follow through where you have additional days moving lower? Do we pull up and retest that neckline from below, which is exactly what happened here with LVS. So again, we have the left shoulders, the head, the right shoulders, the neckline. Here's the setup. We had the trigger where we broke below it, and then we have the confirmation, which is we test that neckline from below and fail. And for the last couple days, you've seen LVS, after testing that level from below, now breaking lower. Now, what else can we look at on this chart? The brilliant part about patterns like head and shoulders tops or complex head and shoulders tops or triangle patterns or anything like that is that you can validate what you're seeing using other technical approaches. Here we have the 200-day moving average, and look at how well that lines up with the neckline and the trigger point and the confirmation, right? When we broke down through the neckline, we were also breaking through the 200-day moving average. When we rallied up and tested the neckline from below, we were also testing the 200-day moving average. Now we've broken down. The momentum has gone from a fairly bullish configuration here in the second half of 2022 to more of a bearish confirmation in the middle of 2023. Now, what do I mean by that? Well, in a bullish phase, the range of the RSI tends to go higher. In a bearish phase, the range of the RSI tends to go lower. So when you have this rally, these right shoulders, where the RSI remains below 60, that kind of confirms that we are indeed setting up this potential pattern. When we break down and the bounce higher, the RSI remains low, even below 50. All of that sort of backs up the idea that this is now transitioning from a bullish phase to a bearish phase, what I like to call an accumulation phase to a distribution phase. If what I just explained with RSI, by the way, doesn't make sense, I have a link in the description below to my latest video looking at RSI phases. You might want to check that one out as well. Finally, I have relative strength at the bottom, and over the last 3 months since the head, you can see that the relative strength line has been going down. And all that implies is, beside the fact that we've seen distributive price action and a negative pattern that's now been confirmed, and we've seen negative momentum, it's also underperforming other stocks. So by owning Las Vegas Sands, not only are you losing money on an absolute basis, you're underperforming the S&P 500, which is just not a great position to be in. So now that we have a valid complex head and shoulders pattern, very clearly defined, we have the setup, the trigger is completed, and the follow-through or the confirmation. What's next? Well, the classic measuring technique is you actually take the height of the pattern and you project that to the downside. So let's take the height. Basically, first we do the neckline, so let's do that. Put that right there. So that's drawing in the neckline that we talked about earlier. So this is that, clearly defined neckline, and again, the break of that neckline is so important. Now we look at a percent move from the peak to the neckline. So from top to bottom, it's about a 20% drop, 19% we'll call it, from the high in May right to the level of the neckline there, right below the head. take that same percentage move and you extend it from the breakdown point. So once you break through the neckline, the thinking is you have a parallel move from the height of the pattern projected to the breakdown point. What this basically implies based on this pattern is if you use this, what's called a minimum downside objective technique, you take the height of the pattern, you project that from the breakdown, that's suggesting a drop to around 44.50, we'll call it, maybe 45 as a projection, a minimum downside objective based on the fact that we've broken down. So what's great about this complex head and shoulders pattern is it gives you an idea of rotation, right? It shows that we're most likely rotating from a bullish phase to a bearish phase. It has all those levels to identify the setup, to get the confirmation or get the trigger, and then get the confirmation when we actually break down through the neckline. And it also gives you a downside objective. That's one of the great things about any sort of basing pattern or topping pattern like this. It's built in with a price objective. So you get an idea based on how big that base was, what sort of downside objective you may want to consider. Also, as we illustrated in the video, using other technical indicators to confirm what we've seen, like moving averages, momentum indicators like RSI, and true relative strength or relative performance, all can help you paint a more complete picture using technical analysis. For Market Misbehavior, I'm Dave Keller. Be well and stay safe. We'll talk to you again soon.